All right, let's talk about balance sheet. Now, ladies and gentlemen, write down this equation in the chat. Asset equals to L plus E. A equals L plus E. Asset equals liability plus equity. Now, most people would just stop at asset and liability. However, that's wrong. It doesn't make sense. Assets does not equal to liability. If assets equals to liability at all times, then you would just be having assets and then paying off your assets at the same time. It also implies that the only way for you to grow your assets is to borrow money from banks. But that's not true. So I want you guys to just back to the basic, go back to the basic. I want you to just imagine right now, if you want to set up a business, how would you go about doing it? You need to raise funds, raise modal, raise capital, right? Can someone please explain to me, where is your first source of money? Where would you take the first source of your money to start a business? Any business you like, where would it come from? I would say out of all these questions, all these answers, they are all good answers. All right, shareholder is a good answer, equity is a good answer, owner invest is a good answer. I would say what I'm hoping to see here is more of what Quenix wouldn't have answered, which is savings or Mei Ang owner. Yes, it comes from you first. It comes from your own savings. Now, when you put your own money into the company and you are the sole director or sole shareholder of the company, you have 100% of the shares. And then if you realize that, let's say you put in 100,000, it's not enough to run a restaurant on 100,000. You need another 200,000. You feel that there's a need for you to get in another two shareholders, perhaps each with another 100,000. So you could see that the first source of funds usually come from the owner, and then suddenly there's owners. Getting funds from these people, getting funds from yourself as a shareholder is to provide, and this is where Ding Zide is correct, equity. And that is also where Goh Kiao Kam is correct. You become shareholders. Now, this equity part refers to that. In your balance sheet, the equity portion refers to you as a shareholder getting in money, putting in money into the company. And then at 300,000, let's say, you know what? Let's say 200,000, because you cannot find the third person. Right? And 200,000 equity. Then you will be thinking, I still lack 100,000. Nobody wants to be my partner right now. COVID-19, nobody wants to set up a restaurant. So I'll go to the bank. I'll go to the bank and says, I have 200,000 right now. I want to borrow another 100,000. Bank says, okay, I'll give you this interest. If you're okay with this interest, boom, 100,000 goes to you. And that's your what? If you go to the bank and then you take 100,000, the 100,000 cash goes to where? Equity or liability? Is that now equity or liability? If you go to the bank, Victoria, thank you very much. Kenix, good. Rajesh, good. So it goes to liability. So the point here, when it comes to liability here, is that you have cash, you want to raise cash, and you want to borrow it from someone, especially the banks or the financial institution. You could also borrow from public investors in a form of corporate bonds. Right? Corporate bonds is just like loans, but the counterparty is not the banks. The counterparty is the public or the investor themselves. So when it comes to liability, it's always about borrowing. So in the chat, write down liability, borrowing, liability, borrowing, liability, borrowing. Well, a large part of liability is borrowing anyways. In a form, it is a borrowing, even for accounts payable. So you can see that with these two things, equity and liability, you get to start a company. With these two things, you get to have assets. Now, of course, at the very first day of your company, maybe the first month, you manage to raise some cash, 200,000 from equity, 100,000 from liability. That's cash. 200,000 from equity, 100 from liability. And cash is what, ladies and gentlemen? Tell me in the chat. What is cash? Don't tell me cash is king. Cash is king is not the right answer here. Cash is where? Cash is parked where? Liability take out cash, liability take out equity. So cash is parked under assets. Thank you. That is essentially what this whole equation, asset equals to liability plus equity, actually means. Well, in a more layman way to explain it. So the way I like to put it here is actually to have this whole idea of looking at your whole business. All right, what I own now in my company is assets. That's what I own. What I owe other people is liability. All right, what I owe other people is liability. And what is really mine is basically assets minus liability. Lah. That's equity. Lah. So this is the most common way that you study probably in accounting or business school. Asset equals to liability plus equity. This is how you look at it at the start of the business. And then eventually, once you make money in 10 years' time, in 20 years' time, you wouldn't be saying how liability plus equity equals to assets anymore. The clearer way for you to see and how your company has grown is to see how much equity you own, because it includes retained earnings. Every year you make more money, it goes back to equity, goes back to equity, goes back to equity. Equity is what you are worth. I don't want to see how much assets I have. I want to see how much I'm worth. Asset minus liability equals to equity. Write that down in the chat as well. E equals A minus L. E equals A minus L. Your equity, your worth, are the entire business's worth. Every year's 10, 20, 30 years worth of retained earnings in equity, showing you how much money that actually can that company can generate. Is equals to your assets right now, including your cash and blah blah blah, minus off the liability, what you owe at that point of time. So what I like to really put a layman touch in the whole balance sheet topic here is assets is what I own, liability is what I owe, and that equals to equity, which is what is really mine. So this is basically how I look at the whole balance sheet. So far, ladies and gentlemen, you can follow. If you can follow, please say yes in the chat. Good. If you know, still say no. It's important for me that I know where you are so far. All right. So to give you guys an idea, like I said, I like to use a restaurant for a business. It's very clear cut. It's like cash business. So what happens for a restaurant business here is that I raise 100,000 for a restaurant. And I go to the bank, I borrow another 100,000 to run the business. Now I got 200,000 cash, one from myself, one from the bank, 100,000 from bank, 100,000 from myself. Those are considered current assets or liquid assets. Right now, my balance sheet is fully formed. I got 200,000 in assets, 100,000 in liability, 100,000 in cash, or rather in capital structure, in share capital, which is equity. All right, so this is basically what is the balance sheet for now. Now, the most important thing here is what to analyze in a balance sheet. Now, this is, I would say, the simplest way I could bring down bring down a balance sheet to its essence. You know that there is two things for you to analyze, which is the assets and the liability. A lot of people don't analyze equity, which is why you don't really know its existence for a lot of you. And under assets and the liability, there's always this thing called long-term and short-term. Listen very carefully as to what long-term asset, long-term liability, short-term asset, short-term liability means. Now, you see, for assets long-term, you're talking about not say long-term in terms of time. You're looking more of a illiquid asset, something you can't sell immediately. You might have to wait a few months, wait a few years. It might not even be a smart thing to do for you to sell within such a short period of time. So when they say fixed asset, you're talking about big item stuff like factory, like land, like property owned, or some illiquid assets, perhaps some kind of contracts overseas, which it is very it contracts for a certain land as well, usually a certain land or a certain assets, which is very difficult to sell. So all these are called long-term assets. Long-term assets, not not very useful when it comes to analysis of balance sheet. There are certain uses, of course, but in the most cases, it's a short-term asset, or rather current assets that's more important, which covers your cash, which covers the inventory. Inventory meaning to say your halfway done goods and your final goods. And then your accounts receivable, meaning to say people owe you money, you do people business, you sell them goods, and then they're supposed to pay you. And then they don't pay you immediately because there is a what they call there's credit terms. they pay you in the future, and that's called accounts receivable. So for that, ladies and gentlemen, I would like you guys to write it down. Current assets or short-term assets. Write down CA would be the best. Right? CA. Write down CA in the chat. That is what is more important when it comes to assets. Now, when it comes to liability, it's very similar as well. You'll see that a lot of people tend to ignore the long-term side. And in this case, long-term liability does refer to time, not just illiquid liability. I don't know what an illiquid liability is. But a long-term liability basically stands for taxes, expenses, especially loans that you are supposed to pay in more than a year. So if let's say the principal is due only next year, basically you're looking at a long-term liability. And if let's say there are expenses or there are tax that you are only supposed to pay next year, more than a year later, that's basically long-term liability. Now, within a long-term loan, anything that you are supposed to pay within a year, let's say you're not supposed to just pay the principal, right? You're supposed to pay the interest. Those interest payments are due next month, the month after, the month after, the month after, all this within less than a year. So when it comes to a short-term liability, again, this is a time basis. Unlike assets, it's not time basis. Time basis for liability means between a year, more than a year. So please write down in the chat, short-term or ST liability, STL, less than a year. STL, less than a year. So the points that we have made so far are more or less three things. Number one, your assets is equals to liability plus equity, or my favorite to look at it is your equity is equals to assets minus liability. The second point we have talked about so far is that there's long-term and there's short-term assets and liability. And then when it comes to assets and both liability, the short-term is a better usage or more popular usage. And then the third thing, and this is somewhat more important, is that when it comes to liabilities, long-term and short-term, the 1 year portion is basically what determines at long-term and short-term. And then the assets, the liquidity of it is what determines it so far for short-term and long-term. So if you take a look at my restaurant business still, I got 200,000 in assets in cash, 100,000 in liability, equity is 100,000. That is us so far. Now, something's changed. Out of 200,000 cash, I buy more assets. I buy fixed assets, right? Like equipments, like kitchen equipments. Now, so the kitchen equipments I buy is not the small one, like, the pans, the rice cooker. No, I'm talking about walk-in freezer. I'm talking about grill. I'm talking about six grill powered by gas. Now I'm talking about really, really strong, solid kitchen equipment, that kind, industrial level, right? So in this case, I spend that 50,000 to buy that fixed asset. So you could see now within the asset, I also split two types. There's a current asset, which is 150,000 in cash, and then 50,000 in fixed asset. So my asset is still 200,000, but it's no longer just cash. It's also the fixed kitchen equipment 50,000. There is cash 150,000. My liability is still the same, 100,000 liability, 100,000 equity. So that's basically the idea. Again, ladies and gentlemen, I just want to follow up more tightly here. So far, if you can follow me, please say yes in the chat. Good. Now, let's talk about owner's equity in detail. In detail. So I think we are all pretty clear about short-term, long-term liability and assets. Now, what is equity? There is no such thing as a long-term or short-term equity. Basically, what happens here in equity is the company's. Guys, give me a moment. Yes. So far we have been covering short-term, long-term assets and liabilities. Let's talk about specifically equities right now. What is there? What is available there? So number one, what is available there is the company's owner's investment. Remember, on a Saturday last week, what did I say about ROE? Return on equity. Equity is not your investor's investment in that stock. It is the company's owner's investment in their own business. equity. So the first thing that you can see in owner's equity is the investment. Now, another thing that is always inside the company's equity is the retained earnings. Ladies and gentlemen, write down retained earnings in the chat. Very important. Write down retained earnings in the chat. So what does retained earnings mean? Retained earnings literally mean the company's history of cash or profits, more like, earned throughout its existence. If a company has 20 years history, then the company has 20 years worth of retained earnings. Every year, the retained earnings either go up or down depending on the business performance. Every year, the retained earnings either have an addition or subtraction of cash, depending on whether the company made a profit or a loss during the year. So retained earnings, you could say, is basically the company history in 2 words. It's the company's history of everything, how they do business, what is their business development point, what is their margin, everything in 2 words. Retained earnings say so much about the company in one single number, retained earnings, and in 2 words. In fact, one of the things that I'm always reminded by my mentor here, and it's something that he always asks me to do, is to basically check your own equity. Check your own equity, meaning to say what, ladies and gentlemen? Is basically to see what you have done for yourself so far, what you have done in the past that leads up to today. Checking your equity means that you are mindful of what and how you have been achieving your own wealth, and in fact more than wealth. So retained earnings here is basically just that. I want you to understand this concept because the fact that when we studied about ROE, we didn't talk about equity, something that bothers me. You see, return on equity also means that there is compounding effect there already. You guys realize that? Right? Your return on earnings is not just a company 20% every year. Oh, I put in 1 million there, I make 200,000, 200,000, 200,000, 200,000, 200,000. No, having a retained earning component in the equity means that your earnings continues to go up and up and up and up. So the fact that if a company is profitable, it has a steady 20% ROE across years, there is also a compounding effect that they are still making a 20% on top of their newly minted or newly injected retained earnings. Again, ladies and gentlemen, if you can follow me so far, please say yes. All right, good. So again, let's take a look at the example, the restaurant. Now the restaurant here I have 200,000. Again, assets, current and fixed, 200,000, still the same. Liability is 100,000, equity is 100,000. Now after the first year, the restaurant is making money and the profit is in my retained earnings now. All right. So that includes the owner's equity. Let's say I make 20,000 profits. So right now my assets got 220,000. Why? 20,000 in cash. And then my liability is still the same 100,000. My equity is now 120,000, which includes my retained profits, retained earnings. So at the end of the day, you can see that this balances out. Right? It's always balancing. That's why it's called a balance sheet. And in the next step, when I receive the 20,000 profits, what I do is I'll use the 20,000 to pay down some debt. I'll use the 20,000 to pay down some debts and interest expense. My assets go down by 210, my liability go down 110, and then my equity still remains at 120,000. All right, so basically this, so guys, you saw some typo there. It's not, instead of 20,000, I'm actually using 10,000 only. All right, so this is a typo there. So the point is that if I use the cash, right, that I've earned, the profits that I earned, saying Huan is retained earnings a net profit? Yes, you can say that. Right? You can say that. So with the net profit here, right, it's also in cash, which I received because this is a cash business. Accounts receivable is a different kind of business. So I may not receive the cash. In this case, restaurant business is a cash business. I take that cash. That means my assets is 220,000 because I made 20,000 in profits. My retained earnings now 120,000. But I use a 10,000 to pay down some debts. Liability go down 10,000 to 90. My equity stays the same, but my assets goes down 10,000, which is 210. So you don't have to know At the end of the day, like I said, all these changes in numbers, I just want to show you how the numbers can change and how it can be confusing, which I'm sure some of you can be and would be confused already, but no worries. Because in investing, you are not required to know this. What you are required to know is the next part. What is net debt, net cash?